Okay, taking a quick look at the past week, the main event was, of course, that minutes of the FOMC meeting that we had from the meeting from July 29th. There was a lot of build-up going into the minutes as the markets were hoping for some reference of additional easing policy from the Fed, and of course, the markets are disappointed, and the minutes did come across as less dovish than the markets were hoping for. Now, as one would expect, we did see some big sell-offs in US equities on the back of that, as well as precious metals came off, T-notes came off, and also saw a big jump in the dollar, even though it was very temporary. Now, the three topics of interest that were discussed in the minutes was forward guidance, average inflation targeting, and yield curve control. Now, regarding forward guidance, the message was fairly similar to that of the prior meeting, saying that a number of participants felt that providing greater clarity regarding the federal funds rate and its forward guidance would be appropriate at some point. And the bank also noted that various participants, in terms of forward guidance, mentioned using thresholds calibrated to inflation outcomes. That comes back to average inflation targeting, unemployment rate outcomes, or combinations of the two, as well as combinations with calendar-based guidance. Now, however, looking at some of the recent comments, it does seem that the bank is currently siding towards a more outcome-based guidance at the moment. Now, then, in terms of average inflation targeting, it was very interesting to note that the comments made by Fed Chair Powell on the subject during the press conference, as well as comments made by other Fed members before the meeting, was apparently not even discussed at the prior FOMC meeting on July 29th. However, it could be argued, that the average inflation targeting would have formed part of the forward guidance discussions regarding calibrating the new policy framework to inflation outcomes. So even though markets were disappointed by the lack of specific mentions of it, it does seem to be a common theme right now among bank members. Then turning to yield curve control, this one does seem to have fallen completely out of favor right now, at least for now. The bank noted that yield curve control might provide only modest benefits and were not warranted in this current environment. So they're not against it completely, but definitely not for it right now. So all in all, the minutes turned out less dovish than the market were hoping for, but arguably not hawkish at all, as the Fed continued to emphasize that there are still significant uncertainty and downside risks to the economy from the pandemic, and markets shrugged this off aside fairly quickly, as the expectations for the Fed to do more is still very high. Looking at the week ahead now, even though the next Fed meeting is not until 16 September, this upcoming week is the Jackson Hole Symposium, Thursday and Friday. This symposium is a major annual event for the Fed and can create jitters across asset classes, as comments from Fed members are closely followed for clues about future monetary policy. Now, the title of this upcoming symposium is Navigating the Decade Ahead and Implications for Monetary Policy, so it will be a very important one. And in the minutes, the prior ones, the bank noted that it will be important to announce changes to the framework review in the near future. Now, given the proximity of the symposium to the September meeting, there is reasonable scope to believe that the Fed will use it to guide markets toward any possible changes in September. Looking at the recent data, it would be a fair assumption that things haven't improved from July and warrants further easing from the Fed. The Fed doesn't want yields to rise. And during the July meeting, if we take a look at this chart, we were still close to record lows, looking at something like the US 10-year and US 30-year yields. And the FOMC minutes that we had this week actually arrived 3 weeks later, if you guys recall correctly. So between now and then, yields have definitely risen across the curve, and that should be a worrisome sign for the Fed. Apart from that, the high-frequency data has also continued to show some deterioration here and there. Jobless claims did show some improvement in prior numbers this week, obviously came in higher. It's still showing a lot of pain right now in the labor market, despite continuing that downtrend. And then on the back of that, the biggest concern for the Fed right now probably is the lack of progress regarding that latest US stimulus bill. The lack of a deal does straighten the recovery and is something the bank has highlighted as a big concern, which could lead to a prolonged slowdown in economic activity. So coming up, back to the symposium with a light week in terms of economic data, this event could be the major market mover in the week ahead. Looking towards sentiment shifts and a trade plan, now that should be very straightforward for this week ahead. Scenario one from the symposium is if we do see the bank and bank members confirm or allude to additional easing at that September meeting, which includes the strengthening of forward guidance by adopting something like outcome-based guidance in the form of average inflation targeting and possibly even extending the average duration of their QE purchases. If we do get that, easy trade plan there would be to expect US dollar to sell off against a basket of currencies like the euro, the Aussie, the pound, and to expect strength in things like the precious metals like gold and silver, and to expect upside in equity indexes like the S&P 500 and the Nasdaq. Scenario two, if the bank does come out and pour cold water on the current hopes for additional stimulus measures being introduced in September, and instead chooses not to adopt an inflation or average inflation-based guidance, and stresses that the bank is currently in a wait-and-see mode, which requires no additional action at that time. What we can expect from that trade plan, once again, expect lots of US dollar strength on the back of that against the basket of the euro, the Aussie, the pound. Expect weakness in precious metals like gold and silver, and expect lots of downside in equity indices like your S&P 500 and your NASDAQ 100. Now, of course, we do cover all of these events in a lot more detail during the week inside the Financial Source Terminal in our daily video commentaries as well as our webinar. So do join us there for more additional guidance and insights during the week.